And I think it's also important for the application layer and the security layer or the protocol layer to have like a net positive sum relationship. So I think at the end of the day, we have to think about building a business, right? Like, yes, you're building a chain, but you're also building a decentralized franchise that's meant to exist for a very long time and be the base layer for everything to build on top of. Like if Microsoft was or Apple did not think about how to actually become cash flow positive over time, I don't think that would age very well.
This episode is brought to you by Aries Markets. To learn more about Aries Markets, follow the link in the show notes below. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. Hey everyone, welcome back to another episode of Bell Curve. We've got a great episode today. Michael, Vance, and I brought on Smokey the Bera of Berachain fame. We're going to be talking all about some of the mechanics and the nitty-gritty, getting into the weeds of Berachain. But before we do that, I want to give a quick shout out to Digital Asset Summit. So this is the conference we've been putting on since 2019. It's the largest institutional conference in all of crypto. It's happening March 18th through the 20th in New York this year. We've got Mohammed Al-Arian, Michael Saylor, Kathy Wood, Mike Novogratz, Brad Garlinghouse, Anatoly Yakovenko of Solana, among many others, Richard Tang, the CEO of Binance. So this one's going to be really good. If you are on the institutional side at all in crypto, I highly recommend that you get your tickets because the ticket prices are going up. So click the link at the bottom of the show notes. Make sure that you get them. And now on to this conversation with Smokey, which this was really great. We got into the weeds of some of the BD tactics, the community building efforts, some of the mechanics around the dual token system. Obviously, I want to disclaim here that Framework, Michael and Vance are big investors in Berachain, but this is a really fun conversation, and I hope you guys all enjoy it. This is great.
The outtakes are going to be fucking great.
That's how we're going to start the pod, with that little line right there. All right, everyone, welcome back to another roundup of Bell Curve. This is a special one. You got all the boys. You got Michael's 1 and 2, Vance. Today we're joined by Smokey, the Bera. Fellas.
What's up, fellas?
Welcome.
BM.
Thank you for having me. BM, boys.
How we doing? Big week. How long has it been since Mainnet launched? 14 days?
Dude, I've lost more or less all perception of time, but apparently we're 2 weeks deep, which is always a pleasure.
Always a pleasure. I mean, it's you launched it maybe the worst time that you could have launched, and things are looking pretty good though.
I mean, there's blood in the streets, and I wish to dance, but I think that nonetheless, I'm glad they're alive. You know what I mean? It was a long time coming, and people are happy.
Smokey, can we start actually with, I think one thing that would be really interesting for the audience is we're obviously going to get pretty deep in the weeds on Berachain here, but I would love to get a sense, what is it like, as much detail as you can share, what it is like to launch a token in the year of our Lord 2025. So, there have been all of these reports about, right? Like, and we've talked about this, Vance and Michael a little bit about, Sky, what it was like getting listed on a centralized exchange. So frankly, everything from just like what the listing process is like for a centralized exchange, what are all the different ticks that you have to kind of line up, to just what is like the strategy for setting tokenomics in today's day and age, right? Like I think sentiment has shifted quite a bit over time in terms of what the allocation should look like between team and investors to community and how you incentivize people. Like Berachain has a really interesting incentive mechanism and sort of set of infrastructures. But yeah, can you just give us like a high level, like what is it like to launch a token today?
Yeah, man. A lot to unpack there. So I guess I'll try to go as top down as possible. I think internally, one of the most important things is trying to keep a team sort of 10 degrees above the horizon. In that, when things are going well, you don't want to get too euphoric. When things are going badly, you don't want to fully crash out. So pretty much when we had our team meetings for the month leading up, I'd say to TGE, I'd pretty much end every team all hands by being like, okay, rule number 1, don't crash out. And I think that is something that's important to hold true, because lots of shit happens. You'll have the last minute partner that flakes on something. On the morning of our launch, we had private safe instances that teams are using to pre-deploy for Boyco, and I can go into that in more depth. And they were trying to migrate their URL, and it just completely borked safe, which meant that we weren't able to transfer tokens to the airdrop wallet that was dispensing airdrop claims. So some shit always gets fucked. I had slept about an hour in our meeting, in our apparently a prayer room that we have, which is like a games room, and woke up like half an hour prior to launch being like, what the fuck is going on? So to give you like, it's always it's more of what variety of shit show have you signed up for? When it comes to listing strategies, etc., I think that exchanges are very much in control right now, no matter what people think. I think that for a period of time, the hyper liquid spot listings, we're seeing lots of traction there, and I think they continue to do quite reasonably. And that's certainly an interesting angle or competition to look at over time. But there's few things that replace the 200 million users of Binance or the 70% that don't sell off Upbit. Like, just the volume is fucking insane, right? Um, so I think that what I have seen evolve is probably the playbooks that people use. Um, and of course, while trying to be respectful of NDAs, et cetera, a lot of that comes down to, on one hand, developing the right relationships with listing exchange agents well ahead of time, being able to show a series of linear data points so that it's not just like, hey, this is a fly-by-night grift. You haven't heard of us 4 months ago. Now there's a Galaxy campaign, pop off. Actually, more of like, hey, you guys have probably seen this for a year or two. There's linear data points that tell you that there's something real happening here. There's an ecosystem they can start to follow. There's many things that they can see as follow-up sources of business, trading volume for them. And I do believe that we're quite successful in that aspect. Um, I think that more and more it is nearly impossible to find yourself getting a quote unquote fair listing or direct listing on exchanges like Binance unless you're a meme coin or CZ stock, etc. And I say that with lots of love and respect, but like the stakes are high and they are the house. So they have no issue, they have no issue making that known. And of course, one can play chicken, but there's also a lot of optionality because one of the other things about TGing in the year of our Lord 2025 is that there's a lot of fucking projects trying to go live. And I think the Q1 is pretty busy from what I've seen, right? We had Story go live a couple days after us. We had Kaito earlier today. Thank you for the Yap Drop, boys. I think we're going to have Initia in the next little while. Like, there's just a lot of these in motion, and half of them I've heard of, half of them I haven't, which just goes to show volume, right? Begs the question of who the fuck is bidding the tokens, but I see that as a later me problem. I think that the other things that sneak up on you a lot, or that we didn't think about a ton until it sort of became more and more prominent, is a lot of folks will tell you like be careful about market makers and they'll rip your faces off, which is entirely true. But very few people I think tell you about how custodians will rip your face off, or the additional degrees of logistical troubles that can come out from that, especially if those custodians have vaults, more physical infrastructure, so on and so forth. I think that becomes pretty important. I think the token distribution methods. Yeah, go ahead.
Quick question. When you say rip your face off, do they generally charge like a percentage of the token supply or something like that? Or what is the...
There's a lot of different ways that it happens. The way that I think has been probably tried and tested the best is sort of a token loan with a call option of sorts, with sort of like a floor and a price at which they can exercise over given time frame, right? So when I say rip your faces off, it's more just like they have a lot of optionality in terms of what they do with those tokens over a given time frame. I think there's lots of ways to hold market makers honest or to attempt to do so. We use the folks at CoinWatch that allow us to have a little bit more of an eye on their supply and how well they're filling certain spreads, etc. But few systems are perfect. You know what I mean?
Maybe before we get too deep into the nuances of listing, launching, whatever tokens, what are kind of the high level stats of what bridged over to Berachain? I mean, what you guys were keeping track of? Because I think it's like there's almost 4 billion on the chain today, something like that.
Yeah, man. So bunch of different stuff. I think that we look at a couple things primarily. What I care about most at the end of the day are our applications thriving, our users actually coming over and using the chain. I think that transaction counts are interesting, and right now, like our transaction count on a daily basis is higher than ETH. But I also think that that's a little bit of a meme at the same time because gas costs are relatively low. Surely people want to spam the network. I'm sure there's people trying to fill blocks to win gas wars, to win X or Y prizes on lottery games type stuff, right? The main things I'd say we looked at, Vance, were one, when we look at actually people who are bridging TVL over. So Boyko brought over what was originally about 3.1 billion in TVL, then closer to 2.6 as the market drew down. And since then, we've seen close to 700, $800 million of inflows. Stablecoins are pretty interesting to keep an eye on over here. So I think there's close to 600 mil, at least, that I know of off the top of stable lick. That's mostly just thinking about USDC and PYUSD, which are some of the main stables that are finding homes on the chain before we have some more of our fair weather friends. There's also a non-trivial supply of USDE over there from Boyko, and we're starting to see more ecosystem native stables like Nect, for example. That's from Bera. A few more of these pop up. The Frax guys are heading over in a little while. Reserve USD, etc., or Reservoir USD, I should say. So that's pretty meaningful because I do think stables are a good indicator of economic activity and just overall back and forth volume. Um, the next big thing I'd say was actually, just looking at some of the activity on different dApps, right? So Dolomite, one of the major lending markets on the chain, just sort of crossed $1 billion in TVL, which I think is insane. Completely organic supply side rate on Bera right now is like 50 to 70%, depending on when you look at it. So that means you can get some pretty pretty gnarly yield on that alone. And then the other thing that we were looking at is sort of yield going to people who are boosting or delegating their BGT. And without getting too in the weeds, it basically just gives an indication of like how much value is flowing from the core applications enshrined into the chain to the people that are effectively providing the most value to the network as we see it in terms of liquidity provision and holding and delegating that BGT token that they get as a result of liquidity provision. And if you look at
maybe just on that point, I think it'd be helpful to understand like what is BGT, what is Bera, what is Honey. Like, let's just get the landscape of the different tokens in the ecosystem as context.
100%, you got it, man. So Bera tries to keep it pretty vanilla. Gas token, liquid token, speculative token, if you will, of the network. This is what validators use to stake at the most base level, right? So one uses Bera as they would use ETH on mainnet. BGT, which is perhaps a little bit on the nose named the Bera governance token, is really where things get a lot more interesting. This is a non-transferable or soul-bound token that is only received by effectively providing liquidity to the network or participating in what we call proof of liquidity. And I'll get into a little bit more detail here, but the thing to keep in mind really is that each validator on Berachain effectively has two portions, if you will. They have their Bera stake, which basically determines how often they produce blocks, sort of like in a linear stake weighted manner. And they have their BGT delegation, which determines the size of their block rewards. And the vast majority of BGT emissions in the network actually go towards people who are providing liquidity to the chain. The important thing to keep in mind, or the concept to capture here, is that in a very standard proof of stake network, you have inflation or block rewards going to the validator set and their stakers, right? In the case of Berachain, that inflation or those block rewards via proof of liquidity is effectively being re-injected into the ecosystem and the applications on the chain in a manner that is determined by the validators on the network and the people delegating their BGT to them. So you can think of it as sort of a degree of, I wouldn't call it, I would call it like a gauge-like mechanics or curve-like mechanics at the chain level, right? So what that really means is that each validator can say, hey, when I win a block, I'm pushing X% of my reward to pool A, X% of my reward to pool B, X% to pool C, etc. And then you can sort of build more interesting markets around that. Honey, to touch on that very briefly, is quite simple. Effectively just stablecoin / unit of stable measure of the ecosystem. Starts out very simple and regulatory compliant, more or less a wrapper for USDC and PYUSD, helping to defragment that liquidity. But we very much expect that to evolve a little bit over time to encompass more stablecoins and help defragment that liquidity, and perhaps even evolve in terms of economic policy, depending on what governance does. So that's the very high level lay of the land. One thing I would add really quickly is that the interesting thing is that BGT entitles people to really, I'd say, do more on Berachain, in that I think it makes governance a lot less of a meme than we may have seen in the past, and is perhaps the only useful governance token as a layer one network level. And what I mean by that is that it effectively allows users, or boosters and or delegates, whatever you want to call it, of the BGT, to earn incentives and fees from applications that are living on the chain being powered by proof of liquidity. And what that really means is that you get this symbiotic relationship between the application layer, who's actually bringing users into the chain, giving people things to do, and the validator or security layer, which is keeping the chain afloat. So don't want to rabbit hole on that too hard before I handle any questions.
This episode is brought to you by Aries Markets. Aries Markets deployed on Aptos in 2022 and is now the largest lending protocol with $280 million in TVL. To learn more about Aries Markets, follow the link in the show notes below. This episode is brought to you by Marinade. Marinade is a high-performance staking delegation platform that brings both liquidity and security to the Solana network by connecting SOL holders with the best staking rates on Solana. Follow the link in today's show notes to learn more. I'm just curious, it's such an interesting design. And, this is, I think, one of the things that some of the other proof of stake chains outside of Ethereum have had to learn. Maybe it's like the Cosmos chains. I think this was a really big lesson, which is there's kind of this idea that Atom, the token, was going to be this index of all the different airdrops for the consumer chains on the hub. But people sort of found that actually the high stake rate is, okay, you could stake and you get this really high rewards, but then people weren't taking their coins and doing anything with them in DeFi, right? So there's this
Correct.
trade-off, this capital efficiency trade-off in between stake rates. And people are pretty optimistic about liquid staking for that reason, but that's never really taken off either. So can you just describe, Smokey, from your perspective of, were there any other, like the dual token model, I think is trying to solve that, right? With like the soulbound BGT token. Were there other sort of like, how did you arrive on this particular design? Were there other trade-offs that you kind of evaluated here? Like I could almost imagine maybe like a really naive design would just be like a native LST mechanism at the validator level where, you redirect LSTs into different dApps. So can you kind of like walk us through how you arrived at this particular design? And then I want to get into like how you thought about which apps to be native and the trade-off between you building it versus encouraging other people to come in and build.
Yeah, 100%. And I think that a lot of that has certainly evolved in our thought process over time, right? On one hand, when we, conceived of the whole idea of like, Berachain in terms of Bera and BGT, close to 3 years ago, it looked a little bit more like sort of these like VE locking mechanisms, like Curve-esque, to a degree of like enforcing a locking, right? And we thought to ourselves over time, as we saw that meta sort of play out, we're like, this is just delaying sell pressure. I think this just turns into something that becomes a messier compounding problem in the future. Maybe we shouldn't lean into what feels like a little bit of an archaic meta that has already sort of done its one trick to some point. No disrespect to Curve, to be clear. I think they built a great DeFi primitive, but to be very clear, I don't think that one could like run that same playbook of lock your shit up for 4 years easily and see the same degree of traction right now, right? So I think that was one thing. We thought a lot about capital flexibility in terms of being able to turn that one BGT into one Bera at any point in time. So that was part of what influenced that design and thought process. I think the other part that we wanted to really enforce was to not have like a weird way of working around the process of providing liquidity, right? Because I think what we just saw was so many of these proof of stake chains that had hundreds of millions, if not billions of dollars securing the network and like, doing their thing in the validator set. But the chain is absolutely a ghost chain, right? And the simplest solutions to that seem to be, okay, well, let's make the only way that you get, or, the vast majority of these tokens going towards liquidity provision, right? I think to answer your actual question though, Mike, there's like a few different ways we could have skinned that cat. This just seemed like the one that was probably the most balanced in terms of usable and potentially integratable into wider, institutional adoption methods. In terms of, you can still earn a small amount of BGT by staking Bera, but it's effectively a fraction, as in like sub 10% kind of thing compared to what you get by providing liquidity. So, you get a little bit of optionality, and at the same time, it ends up being a mechanism that's pretty well understood by the vast majority of people participating in anything on chain. And this whole idea of liquidity provision is really, I'd say, the core aspect of DeFi as a whole, right? I think a lot of things just sort of revolve around that and end up being derivatives of liquidity provision in some form or the other.
Yeah. There was actually an early idea. I don't know if you ever looked at like, I think superfluid staking, Sunny from
Yeah, with
Osmosis used to call
Osmo.
it.
Yeah.
Yeah. But this is kind of what that reminds me of a little bit as well. It's like the unit of, it's for folks who weren't familiar with that idea, it's reversing the order of doing an LSD and then going into an like LPing on an AMM. It was taking your LP from an AMM and then reversing the order there. But
the other thing I would say that's interesting from just POL and just the amount of assets that are on chain today. So there's a single lending protocol called Dolomite, which has $1 billion in TVL today. You can borrow ETH at 0.01%. You can borrow USDC at 0.16%. And the lending markets are super deep. Like you can borrow probably $80 to $100 million of size from this. And I think this kind of like speaks to what probably is like an emerging meta or something that's just taken a break for a while, which is like looping is always the killer use case of emerging blockchains. Like you saw that with Steth growing, where instead of getting like, 1,000 new customers, they just took the existing 100, customers and gave them 10x leverage on their Steth. Like RWAs and frankly, like other, private credit plays, like those are going to be prime looping candidates as well as just like ecosystem native applications. And I think what you're going to see is like, I tweeted this today, but like ETH and Bera right now are the two deepest lending markets in crypto. Like that's a huge structural advantage as things move from like kind of like a meme coin / like a swapping centric market to something that's a bit more leverage focused, especially as the borrow rates in TradFi comes down. Like the lending markets on these chains are only going to get bigger and bigger. So I think that's just something interesting to point out. Just like the lending markets on Bera are competitive with ETH, and that's about it in crypto. But like maybe like tying it all together, I mean, thinking about what investors want in terms of L1s today, it seems to be like a super aligned ecosystem with apps rowing the same direction as the chain. No instances where like an app is making more fees than the chain. I think that's one. Obviously, like low cost, high throughput. You don't want retail to be forced off the chain. That's kind of two. I think like a solid investor base is three. Just like you've seen the difference between like a KOL led ecosystem and like a more of a VC or like community led ecosystem. But like what else do people seem to like in Bera, or just like kind of this new complex you've created?
Yeah, I mean, I think one thing that people have leaned into the most kind of ties back to your first point, Vance, which is like the applications and the ecosystem are more aligned than anywhere before, right? And it's not just, hey, we've got this retroactive grants program. It's not just like, hey, I know a guy who knows a guy and he gave this dude some advisory tokens. It's very much, hey, like there's an actual, base layer mechanism for the chain to drive value to the applications. And that is relatively inescapable. And, sort of going towards what Mike, I said before, right? Like it's not quite just a native LST. It's actually just the chain functions by powering its applications, and BGT accrues value by those applications passing some degree of incentives or value of their own tokens back to the chain, right? So both sides are capital efficiency maxing, and both sides are aligned towards their own outcomes. And I think the
One clarifying point, just because I think it's useful, is how does the BGT, and we didn't really touch on this exactly, but like you're earning BGT by staking your Bera. It's a non-transferable token. You can swap the BGT for Bera, but what do you get to do with BGT in proof of liquidity? And like you just touched on the incentives model,
for
and
sure.
we kind of like what the next phases are of growth for Berachain, but I know applications and having applications launch and go mainnet is one of the big hurdles that you guys are working towards. But like, how does that interact with BGT?
Yeah, 100%. And that's a great question, man. So, the biggest and most important thing that you can do with BGT is actually boost a validator and or choose to delegate to a different validator. And this is where people can very much get opinionated because they've earned that BGT in one of two ways. Either they've provided liquidity in a venue that is already receiving effectively, POL emissions. Right now, that's just the chain DEX or the native BEX as we call it, which is meant to just be as safe, simple, sort of bootstrapping ground as possible. Or they've staked their Bera with like an LST or like a natively through a validator, and they're earning a very much a fraction of that LP yield. So somehow they've got some BGT, they're figuring out what to do next. Each of these validators effectively has their own cutting board or pie chart, which basically dictates what happens whenever they win a block and which pools they're choosing to push those emissions towards across the network. So it could be the borrow side of an ETH market on Dolomite, like Vance mentioned earlier. It could be a stable pool in the DEX, right? It could be a more spicy concrete type derivatives protocol that's trying to sort of get off the ground and start flywheeling. And what will ultimately dictate where most validators likely end up pushing their emissions ends up being the free market, which is to say that these different protocols on the chain will actually incentivize validators in a first come, first serve style order book saying, hey, I'm willing to pay 10 units of my token in exchange for 5 units of BGT or whatever that might be. And if a validator effectively chooses to change their cutting board or their pie chart, if you will, to that distribution, then they start earning a portion of those incentives from those applications, effectively replacing a traditional liquidity mining type protocol, and then distributing the vast majority of those applications rewards to their delegates. So that means that you can have validators that sort of end up very opinionated and say, hey, I'm going to take super low risk bets. I'm only going to accept incentives in the form of like stable coins, or I'm going to nuke whatever I have into stable coins or Bera or something, and then distribute that to our delegates. You could have sort of venture style validators that say, hey, I'm going to incentivize a whole bunch of these more like long tail assets and these new projects coming up on the chain like Yeet and Baradrome and Dolomite and Kodiak and Exponents and so on and so forth. And hope that these tokens all gig ascend and that I get to participate in that upside. And I expect you'll have folks that try to operate close to like, hedge funds or ETFs as well. And that some of them might just try to denominate into majors. Some of them might actually try to apply their own trading strategies to some of those profits, et cetera. Right. So at the end of the day, to really answer your question, Mike, it means that the validators are receiving incentives from the applications in exchange for choosing to push part of their block rewards or effectively inflationary rewards of the network towards those applications, which are in turn passed on to those applications' users.
So it's kind of like a reversing, I would say, of the expectations where, the fees are generated by the applications. They're stored within the treasuries of the applications. They're paying fees down to, in the form of the gas token down to the blockchain that they're built on top of. And the inflationary rewards are going to the validators who are securing that network and basically proliferating those applications. This basically turns it around and says, you point your BGT at the application, that boost then effectively gives that application more Bera as a form of compensation for the inflationary rewards, and basically you're compensated by the token and sort of the boosted amount that the applications want to deliver to whoever is boosting their apps.
Yeah, I mean, the way to think about it, like equivalent exchange wise, is that the validator set has to point their BGT somewhere. So they point that BGT towards the applications that are willing to, in turn, push part of their native tokens or whatever tokens they're willing to incentivize in towards towards that validator, right? Because that effectively just means that the validator can say, hey, I'm going to take a call option on you guys and help support. Perhaps that validator has a number of large LPs who have boosted or delegated towards it that want to effectively auto compound their own yields in a pool that they're in, right? And that application then basically says, okay, instead of doing sort of like this open-ended liquidity mining program where I'm going to pair my token against Bera and then emit a whole bunch more Bera or something like, or of my own token, etc. They actually just say, hey, I'm going to give some of my tokens to this validator, and they're going to give a whole bunch of emissions to my pool. And in a perfect world, we see that gap getting as close to one, or at some point, positive sum as possible, right? Applications are always going to want to incentivize with $0.8 and get $1 back worth of emissions, and the chain over time would love to be able to see that get to the point where it's 1-to-1 or 1.1-to-1, et cetera, right? And that's sort of how you end up with a degree of positive unit economics for the system. The other interesting element there is like the most basic and the standard version of POL, I'd say, is sort of that exchange between tokens and tokens, as in native application tokens going to a validator, BGT going to an application's pool. But that can also be in the form of fees, and I think that's where it gets very interesting and even more sustainable, where an app kicks back some portion of its fees to the validator. In exchange, that validator is pushing more BGT rewards to the app, right? So that you can sort of end up with that turbo cycle.
So, Smokey, zooming out for a second, I think maybe some of the historical problems that L1s have run into that Berachain is trying to solve is one, the sort of the capital efficiency problem at the validator level, the alignment challenge in between L1s and the applications that are built on them. You see this in Ethereum. Oh, this is extractive, and I'm sure when apps start earning revenue on Solana, it's going to be the same thing. So sort of that balance, right? And then ultimately this sort of this kind of VE tokenomic design, which actually, we talked about Curve and maybe Convex a little bit, but actually the original, the sort of design here was actually Bitcoin, right? Like Curve was directly inspired by Bitcoin. And, when I think about the Bitcoin design and the Curve design and, what you're describing with Berachain as well, is there's a certain amount of like reflexivity as well, which is, the Bitcoin, in order for the security budget, right, to be, paid, you either need transactions or the price of the token needs to go up. Same thing with Curve and the gauge. And I'm wondering how you view, would it be fair to say basically there's some amount of reflexivity baked into the Bera ecosystem where if the Bera price is going up, everyone's getting paid in their Bera, and like that's good, right? You actually want people to be like tethered to this like kind of reflexive asset. But I guess the negative would be if Bera started to go down and then the reward emissions like were worth less, and so apps were less motivated. Is that like roughly a fair thing? Would you describe it as a reflexive system, or is that a wrong sort of take?
No, I think you've got a good grasp on it, and that there's a degree of reflexivity. I don't think it's like shocking to your reflexivity, but I think the roller coaster has a couple bumps. The way I'd see this is that there's a couple things that we expect to help dampen those effects. One is some kind of cool stuff that I know different governance teams are working on that involves almost a degree of like responsive inflation or responsive staking rates for Bera and BGT. Which is to say, in times of economic contraction, you're going to want to incentivize people to stake more Bera, right? And sort of stabilize that network and create a little bit of that sink. This is by no means in place yet. The network's still very much in its nascency. So I see this as something that's, a couple quarters down the road, but something that's pretty interesting from an economic policy point of view. Another concept which I'm quite bullish on personally is just this idea of creating a range-bound incentive system that effectively helps match the degree of inflation with the amount of incentives actually flowing into the system, right? Such that, if that incentive rate spikes massively and apps are bribing like mad and all of a sudden the cash flows going to BGT are sort of like 1.2, 1.5 to 1, then maybe the inflation increases. Whereas if it is falling off a cliff, then inflation decreases a little bit. I think that's how you actually end up with a little bit more of that dampening effect. I do think it's important to have a meaningful distribution phase and a time in which the network just sort of like path finds its way to what a stable incentive base looks like, because really that is what will control or dictate a lot of that reflexivity. I think the second part of that equation, I'd say, Mike, is sort of what I was referring to with Framework Mike, which is to say that apps pushing fees towards validators also becomes a lot more sustainable in that sense, because then it's not necessarily just the value of their token emissions. It's, okay, cool, if people are selling, they're still racking up fees, and that helps to serve as a little bit of a cushion for that value accrual mechanism. So like my TLDR here is I expect some degree of reflexivity. I just don't expect like unholy reflexivity.
Maybe just talking like more specifically about like, POL, obviously like there's a permissionless forum, there's a forum that's like working towards permissionlessness. Are there any things that you can tease in terms of like maybe base level primitives that you're aiming to incentivize first versus second versus third, or yeah, just like any context would be great.
Well, I think on one hand, it's one where I personally can't be overly opinionated, because like my role in governance is pretty much zero, right? I talk to the teams, I talk to folks and figure out what they're planning on putting forward to various forums. So I have a little bit of a barometer on what I think is going to be out there. But in terms of actually saying, hey, this is going to happen versus this isn't going to happen, no fucking clue. Funnily enough, I actually haven't gotten my tokens from custody yet. I should probably do that at some point. But in any case, they're like, yo, bro, yeah, I was like, yo, I hear insiders are dumping. Where are my fucking coins? But in any case, what I would say is that I know folks that leaning into what Vance was saying earlier, and without being too corny, like give me some leverage and give me a lever and I'll move the earth kind of thing. I think that there's definitely going to be applications that will lean into that and turboing it with POL. I think there's probably going to be some derivatives type groups that try to get off the ground, because I think that PL is probably one of the best fits for these derivative protocols that rely on a constant stream or sort of velocity of capital going in and out. So things like spicy perps, credit defaults, prediction markets, that kind of stuff. And then I think just like well-known models that require emphasis at certain points. So your sort of CDPs, your AMO type products, I expect to see a lot of those. So as I see it, it'll be DeFi primitives, then sort of spicy DeFi primitives, then sort of weirder consumery stuff. They'll use POL to almost incentivize certain actions within that application.
And what's like, I mean, the end state of this, in my mind at least, is like the fees that are associated with Berachain are going to be the lending fees, the swapping fees, the perps fees, like the fees from basically all applications are going to encompass the valuation of Berachain versus ETH, where it's like those are all kind of their own separate tokens and their own separate valuation frameworks. But like it feels like it's possible for you to get to like multiple billions of dollars of chain, fees in pretty short order here. And that's like kind of dovetailing on this trend which you started of just like apps with chains with enshrined apps enshrine liquidity.
Yeah, I mean 100%, right? Like I think there's certain words that my GC would like me to use and would not like me to use. So I'll be cognizant of what I do say here.
You have a GC?
Yeah, fuck, I know. but I do think that it's important for someone to have a reason to hold a non-transferable soul-bound token that accrues value in a network, right? And I think it's also important for the application layer and the security layer or the protocol layer to have like a net positive sum relationship. So I think at the end of the day, we have to think about building a business, right? Like, yes, you're building a chain, but you're also building a decentralized franchise that's meant to exist for a very long time and be the base layer for everything to build on top of. Like if Microsoft was, or Apple did not think about how to actually become cash flow positive over time, I don't think that would age very well. So our goal over here is to get to a point of sustainability, right? And I think that is a function of having the best applications that really do end up seeing a degree of product market fit, and then having those apps be so successful that they're able to drive value to the chain itself and create a bit of a virtuous cycle there.
Yeah.
And I think that there is sort of like a fine line between like enshrining too much and enshrining nothing, which is why we've tried to be relatively light in terms of our opinionation there. Sort of just basic DeFi primitives to start, which is why we sort of mentioned, the BEX that's there so that people have a very simple, safe, battle-tested design and place to start earning BGT to start, be a lending market over time, et cetera. And I think we work our way then into the more exotic stuff that, isn't meant to be hogged by the chain. It's actually very much just meant to be there, such that there's a standard that's set. In fact, I think that it's much better that we have some degree of enshrined applications in terms of that back spend, et cetera, as opposed to just having the ecosystem be home to like 20 different shitty Uniswap and Aave forks and having people wonder, okay, which one am I going to get rugged on? Which of these is actually going to survive at some point? I would almost rather like have a little bit of that mini Fed state to start, such that the people that actually excel in the future have had to like surpass that enshrined bar of performance, if you will.
Do you? I'm very curious, Smokey, over time. How do you view the trade-off? I mean, I know you were just kind of getting into there a little bit, but it's been interesting. And I think you've seen maybe a trade-off here, even in between, something like Ethereum, which is very infrastructure heavy and it's very reliant on sort of third party or the private market to make solutions, versus honestly even like a more monolithic sort of design where a lot of this is kind of built into the functionality of the L1. And I feel like enshrined applications are the next natural evolution of this. How do you view the trade-off in between, or maybe could you get a little bit more granular in terms of how the DEX feels like the obvious one, right, to me.
Yeah.
But how did you kind of look at past the DEX into the different applications that we would want to enshrine? And what are the plans for enshrining in the future? / is the expectation that you think that eventually private market actors will outcompete you, or do you expect like BEX to be the dominant one into the future?
I mean, I would hope that private market actors outcompete us over time, and that the back spend, et cetera, very much serve as like baselines or like fallbacks, if you will, right? Safe refuge in a wild storm, if you get what I'm saying. I think when we balance that equation, it's actually kind of funny. When we started working on Berachain, FTX was still a thing, and we're just like, man, it'd be so cool if we built like an on-chain FTX as a chain of sorts, and you'd be able to like swap and go long on stuff and like leverage against things, etc., without thinking twice, and it would all be interconnected and beautiful. Turned out that was like not very feasible in a centralized or decentralized manner, as we came to learn. But that did inspire some of our initial choice in terms of primitives, in terms of having like a DEX, lending platform, perps, etc. Because we very much saw these as like the most basic things, or I'd say the standard set of activities that people do on chain, or for that matter, kind of off chain as well, right? We weren't going to go in there and say, hey, we need to build like the options protocol and the yield swap and like the NFT marketplace and the naming service, or many other weird spicy cash cows. It was more like, hey, let's build out the basic primitives that people can use as building blocks for a little bit of everything else, right? So I think that's very much the same opinion that we take right now. Not trying to black out the screens and leave no space for people to innovate, but rather help create a baseline for the products that are normally taken over by grifters, and then use that such that people can actually build around that, or ideally, outcompete it. And then enshrine something that allows the free market to have to outcompete that as well. Because right now, 50% of the LP fees from the BEX are going towards BGT holder, or BGT boosters effectively, right? Which is powering right now like 150% yields for people who are just boosting their BGT, which is like insane, all paid out in honey, the stablecoin of the eco. But what I'd love to see, and what I expect to see over time, is more and more of these applications saying, okay, cool, we're going to kick back 20% or 30% or whatever it is of our fees, plus incentives in the form of our native token. And that's why this validator is going to push these emissions to me instead of the BEX, right? So I think that's sort of like both the social and technical contract we want to enforce over time.
Quick shout out to today's sponsor, Aries Markets. Aries Markets deployed on Aptos in 2022 and is now among the top 10 lending protocols across all blockchains with $280 million of TVL. Aries Markets has expanded its product suite to become a fully integrated DeFi hub combining lending, borrowing, and more. In 2024 alone, Aries introduced several new features to better meet the needs of its users, including native USDT support, an incentive program, and more. Click the link at the bottom of the show notes, head over to Aries Markets, and tell them that I sent you. Hey everyone, quick shout out to today's sponsor, Marinade. Since launching in 2021, Marinade has expanded their suite of products to provide solutions for both DeFi users and TradFi, including liquid and native staking, as well as direct enterprise integrations. Marinade's platform is optimized for institutions to securely expand their exposure to Solana. Whether through the provisioning of custodial or non-custodial yield, integrating staking rewards into Solana financial products, or leveraging Marinade's best-in-market rewards rate for revenue and treasury management. Whether you're in DeFi, TradFi, or somewhere in between, Marinade has something for you. To learn more about Marinade, follow the link in today's show notes.
Can you talk a bit more about Honey and its role in the ecosystem?
Yeah, man. Honey's had many roles over time. On one hand, great meme. Like I think people like Honey. At one point, the tagline was "Honey is money," and then legal was like, "You cannot fucking say that." And I was like, honestly, that's very fair, which is why I'm disclaiming this quite heavily. And then at another point, there was someone who was posting nonstop that Honey needs to go to $5, and I was like, maybe that's not quite right either. But I think that to seriously answer your question, I think stablecoins are one of the most powerful forces within crypto or DeFi as a whole. I think they're one of few things that have real adoption. And I think they're one of few things that will probably survive regardless of what happens to the industry over 10, 20, or whatever her time horizon, right? We often found that as many people, go to a new chain, their stables are super fucking fragmented. You'll have 20 different bridges and you'll have 20 different versions of USDC, USDT if you're lucky, and then, Frax and whatever else might be alongside there, DAI, so on and so forth. And the original thought was Honey would be a little bit more of like a meta aggregator of sorts of these stables, such that they can still find a home, if you will. That being said, a stable is only as strong, or a meta stable is only as strong as its weakest link. And we also like to be regulatorily compliant. So Honey very much starts with the most basic stables in terms of USDC and PYUSD, which we think is pretty interesting from a long-term point of view, because despite masquerading as cartoon bears on the internet, for the most part, the guys at Berachain, including myself, were suits in a past life and spend most of our time in VC, PE, building companies in the Valley, probably not too far where you guys are right now. And we think a lot about how this actually goes beyond the Ponzi games on the internet, which lots of fun. Like, and I wouldn't trade for the world. But I also think there's a point where if you want to be the next Ethereum, the next Bitcoin, the next Solana, I don't know if you can be the next Bitcoin, but you know what I mean? If you want to be the next chain that makes it out the hood, then you actually have to find a way to get into people's hands. And stablecoins are one of the most tried and true ways of actually getting a degree of under the hood institutional adoption, whether that is hilarious Shopify type integrations, whether that's integration to PayPal type payment apps, whether that's these e-commerce layers, or if one was to look at the DeFi angle, getting more complex and sort of floating interest rates and capital efficient designs over time, which can then go back to that whole thesis of how do you make the chain cash flow positive, right? So we see those as the two routes. Like Honey is either institutional penetration or number grow up technology in a sustainable manner.
Smokey, that so as Vance was describing, like one of the superpowers of DeFi, or what something that an activity that drives an enormous amount of transactions and fees, is looping.
Yep.
It reminds me a little bit. I was just having a discussion with Lido, announced their V3, and Konstantin and Hasu came on and talked about this, and he mentioned looping as one of the core features that are like use cases that they were trying to enable. What has the profile of the average looper changed over time? Like, I mean, one thing that, and just getting a little bit back in the weeds on DeFi in general, and it feels like actually looping has become much more institutionalized. Like, I'd always thought of loopers as basically like kind of 2021, like degens, meme coins didn't exist yet, and maybe pre NFTs, people were kind of like ripping these loops and getting liquidated and making a lot of money or losing a lot of money. But it seems like it's actually gotten much more professional, and just the sophistication. So can you just describe, I think people kind of have this picture in their mind of like a 2021 retail looper, but has it gotten more institute? Like, how's that changed over the years, you think?
Dude, massively so. In fact, funnily enough, not long before I got on this call, I was talking to the guys who have been the guys who are effectively the firm that help us manage the largest borrows of ETH on Aave, because they've been diving deeper into the ecosystem, helping deploy assets, including PYUSD, etc. And we were just talking about different liquid opportunities on the chain, and I was like, dude, you guys should check out Dolomite because like we got some gnarly loops over there. And the fact of the matter is that as more and more yield-bearing assets find their way on chain in sustainable and battle-tested ways, which I'd say has primarily been ETH and stables at the moment. So think your Athena, something to something usual, et cetera types. You get these loopers coming in droves because they're getting many multiples over their standard T-bill rates, and their risk profile really isn't that far off. At least if they're already willing to be on chain in some way, right? So I think that we're seeing more and more people either doing institutional earn programs through these sexes or asset management firms or even hedge fund types, and playing with very like battle tested assets here. I don't think we see looping go anywhere for quite some time. I think it's also been quite a while since we've seen like a lending market like massively blow up. So maybe that's why people are a little bit more risk on in that sense as well. Um, But the TLDR is, I think the average looper is more likely like a family office or institutional type player than it is a DeFi degen nowadays. At least if you weight by size.
And I would also say like some of the real world asset stuff that's like further out on the curve, like energy specific, um, they're deploying on Berachain. They're excited about Berachain, and like it's not like Berachain was built with the institutional audience in mind necessarily, but POL and the deep lending markets make it like the only place that you can really deploy on where you're like, okay, I'm going to garner enough liquidity where I can actually start to loop, and like that's what these RWA projects need. So like the institutions are coming whether they kind of like it or not.
The institutions will come to the chain with a bear on it, and I think the other reason that they might come home is unironically Bitcoin, right? This has been a little bit of a meme, and like I think it's still a little bit controversial at this point in time, and jury's out. But I do think that the ability to stake Bitcoin and do something with that is interesting. I think that Advanced in the Framework guys are involved in Babylon as well, and I think Bitcoin security is something that will either change the game entirely or completely flop. I'm hoping for the former. And I'd say that right now there's probably close to $1 billion, if not more, of staked Bitcoin type denominated assets on Berachain. And when you think about that combination, right, you've got the most hardened asset in history that is being treated by like digital gold, and having every pundit talk about it, and having everyone who wants to get exposure to crypto play with it, starting to have a 0 to 1 yield source from securing other chains or securing L2s, et cetera. Right. And while I do think that there is a large task of finding enough people that want Bitcoin security, I think that the ability to have, over 1%, let's say, or even over 0.5% yield on Bitcoin, and then loop that will be absolutely insane for some of these folks that are, meaningfully risk off and looking for opportunities on assets that they already hold. And if you find a way to do that with native Bitcoin in some manner, which is already sort of built into some of these solutions, then you just, you have an unholy, triple decker sandwich of good tech. So I think that's one of the other things that's on my radar as an exciting opportunity that can be uniquely turbocharged on Berachain, because you juice one of those looping one of those loops with some POL rewards, and you can take that to the bank.
For Smokey, that's Chipotle on Chipotle on Chipotle.
Oh baby, yeah, we got to
Chicken on
witness
chicken on chicken.
this conversation. What is founder mode when you're launching a chain?
Dude, that's a good question. I think the term founder mode is corny as fuck, to be very honest. If I was to start,
it's pretty good.
It's good, but the problem is, it's much like when SoundCloud DJs like big things coming. It's when it gets taken over by a bunch of like the LARPs, and maybe I'm a LARP too. Fuck, but like when it gets taken over by a bunch of people, then you're like, man, I do not want to be in founder mode. I would like to be like cooking, perhaps. Actually, what we have is my team. I kept on saying in many places, give me the rat and give me the hat, and I'm gonna cook these motherfuckers. So my team got me a Ratatouille headband. come to use every now and then. But I think founder mode is being on top of literally every last fucking thing and not forgiving yourself if you miss something. That is sort of what it boils down to, which is to say you have to be, on one hand, crash out pleased with the team who are managing a number of different things. We had Jack thinking about how to make sure the $3 billion gets moved over to the chain safely without RPCs leaking, and coordinating with 100 different parties to effectively make that happen, which was insane and anxiety inducing for all parties. It's making sure that all the comms are happening at the right times, whether that be with exchanges who like to bombard you with different asks on the last minute and the night before at 3 a.m., or whether that just be with partners who are going to be important, whether that's oracles or safe or tenderly, whatever you might have. I think it's making sure that the community is aware of what's going on, and that there's crisis communications, and that if shit goes wrong, there's a way to handle it. I think it's basically just like extreme ownership is my take on this. As in, something goes wrong, you shit the bed. Something doesn't go wrong, you probably still shit the bed. You just don't know about it yet. And then cleaning up the messes along the way. That's sort of what it boils down to for me.
This episode is brought to you by Morpho. Morpho is the first and only DeFi protocol Coinbase has integrated directly into their main app, giving millions of users access to borrow against their Bitcoin on Coinbase. Just as Web 2 companies like Google, Amazon, and Meta were built on internet protocols, the largest financial companies of the future, such as Coinbase, will build on decentralized protocols like Morpho. Whether you're an individual, fund, fintech, or institution, Morpho is for you. Follow the link in today's show notes to try Morpho today. Smokey, what do you think can you just like peel back the curtain on what it's like to do kind of like BD and like courting applications these days? Like, I'm very curious. Actually, Michael Vance and I were talking a little while ago. I think like the major L1s that have made it, one of the common themes they have is there's like a specific type of guy that you can think of when it comes to that ecosystem, right? Like Bitcoin's like the macro doomer, ETH is kind of like the optimist, like Solana maybe is a little bit more pragmatic or something like that. You know, I'd be curious almost when you're thinking of, you know, when you close your eyes and you think about the ideal person or participant of Berachain, like what does that look like? And actually, Victor Bunin wrote a great post about how the BD meta is changing for L1s and is kind of moving up in the life cycle of the L1 product. So maybe we could start with kind of like the maybe foofier question of like, what does a Berachain ecosystem person look like in your mind? And then we can get into some of the tactics.
Yeah. We've thought about this a fair bit. I think the answer that keeps on coming to mind is like retard savant, in that like they're pretty far left curve and they're not too far off on the right curve either. In that like
the perfect balance. It's the Goldilocks of curve.
Yeah, like they kind of got like that horseshoe theory going. In that, listen, there's definitely something wrong with them, but they're quite good at what they do, and I think that has probably been the most prevalent trait. And that if you look like, you know, at some of the most prevalent apps in the Berachain ecosystem, there's like the Honey Jar, and, you know, Janny, for example, who has his own massive following and sort of cult status in the ecosystem. He refers to himself in third person and has, you know, and communicates in like this, like, you know, squeaky Jenny voice. And it's the funniest thing, but he's also built, I'd say, the closest thing to a super team type Octopus meets like Atomic Labs type product studio, that's building everything from community perks aggregators to NFT mints to LSTs to, like, you know, I'd say questing programs, et cetera, just all these levels of ecosystem support. And the dude just comes off as a complete clown car if you haven't spent that much time talking to him. And then if you actually dive into the weeds, you're like, holy fuck, like buddy's thinking. So like there's guys like that. There's guys like Lord Pemby from Yeet who communicates, again, sometimes in third person and sometimes just goes on a spaces and says Yeet for like 5 minutes straight. But has built quite a thoughtful like bonding system plus on-chain game of sorts, and has built a pretty interesting community around that as well. So like I think that you get the folks who will probably be passed over from the first time if you look at them from a purely traditional lens, but will be the people that you FOMO into later. I think that's probably the most, you know, the deepest commonality I've noted. So like I don't know, I think I may have discussed this with Vance before. It's kind of like if you took like there's little parts where it's like if you took people in the base ecosystem and kind of like deep fried them and schizoed them a little bit, but also added some like more interesting twists. I think that's a lot of the the Berachain energy.
It's a little countercultural in a sense, right?
Yeah,
like
yeah.
Yes, but like you need the cyberpunk values.
You
like,
do, man.
Like, what are we doing?
Right. Like, I don't think it's the basement dwellers and the guys who are like scaring girls at the party, but I do think it's the people who are like probably a little bit socially awkward until they get 2 or 3 drinks in them, and then kind of like, you know, have some pretty cool stuff to say after that. Like maybe they really like keyboards. I don't know.
I love it. All right, so we've
Sorry,
got the
pods.
Yeah, I hope you're not heating alive under there. That's your soldier for putting that on the whole pod.
I'm not bad. It's pretty funny, actually.
So take us in the BD trenches. And for those who haven't read the Victor Bunin post, his idea was kind of in the beginning there was like almost no BD for something like Bitcoin, right? And Ethereum was very organic, and then there was more of a coordinated BD function, which happened once the chain went live. And then I think you guys and like Berachain and maybe Monad as well did a pretty good job of moving it up even a little bit further in the life cycle. And you guys were a big presence at ETH Denver events, you know, with kind of parties and gatherings and hackathons and stuff like that pretty early, like well before the chain launch. So, you know, talk to us a little bit about that strategy, and then also, what the pipeline kind of looks like for app devs and users and whatnot out there in the world today.
Yeah, for sure. I think that the simple answer is if you don't, you know, go out and tell them that it exists, no one gives a fuck. In most cases, like there was at one point this thesis where it's like if you build it, they'll come, and then people tried that and they're like, wait, where are the people who were supposed to come? So we realized that I think relatively early, And part of our gift and curse there is that we just like didn't have a chain for so long that we had to do BD because like, well, what the fuck else are we gonna do? Like talk about how we don't have a chain. So got out there messaging people in the right trenches in Brooklyn or in deep quarters of Discord and the internet and Telegram, and tried to meet the most sharp app devs that there were. In some cases, that was a matter of like finding communities that sharp people congregated around, especially when that was sort of like DeFi leaning, and then sort of following those like network trees a little bit farther down, right? So I think that was perhaps the attitude that we took, which is very much the opposite of laissez-faire. In the earlier days, I sort of had KPIs for different members of our ecosystem or BD team in terms of sort of like the number of calls they should be having. And I think that has some degree of use, but it ultimately falls off a cliff at some point if you're just like filling a calendar for the sake of filling a calendar. We eventually managed to refine that from like, okay, we've gone super wide to, there are these different tiers of teams. There's some groups who we think have lots of potential. Let's double down and really spend as much time and effort on them as possible. Of course, there's a base degree of support to be provided to anyone looking to build in an ecosystem, but there's only so many resources, and at some point in time, you have to be a little bit more opinionated and say, hey, look, like if our ecosystem wins, it's probably going to be as a result of these 20 to 25 dApps, let's say, that are really going to make it or break it and catch that virality, if you will.
Question on this process, just to double click into 2 points. Number one, you're building the chain as you're also doing BD. How did you guys think about like collecting? I mean, in a lot of ways, the application developers are your customers, and it's not a pure comp. But if you were to say, listening to your customers is like what you need to do during product development, like how much was the feedback back and forth of like talking to the infrared guys about how to build staking and staking mechanics and like what they needed, and like how much of it was just like, hey, here's what we're building, and like if you guys want to build, like you should build.
Look, I think I wish we did more of this over time. I think we did an okay job, but we could have certainly done better in terms of having like that iterative, product development cycle. I think in many cases we just set the expectations too soon for ourselves. So many times it felt like we were in like an infinite game of catch up. And even now it does feel like that a little bit to some extent, right? But I think where we were able to outperform was by identifying the tooling and the basic piece of infrastructure that each of these teams needed, and making sure that we had all of that set up and locked in ahead of time, such that it's not like, hey, I'm waiting months or weeks for that matter for the infrastructure that I need to build my DApp that I would normally have on mainnet, whether that's like your gelatos or your account abstraction solutions, or can I use Hard Hat or Foundry, whatever it might be. It was very much all that stuff is ready and outside the box. There's just definitely certainly things where I would have loved to have like iterated more on teams along the way on staking design, et cetera, if we had more time. So I'd say like, we covered our basics and some in terms of infra, but we could have been even better at it.
And then equivalently, as you were thinking about like the universe of potential applications and developers of applications, were you like, all right, we need someone to go off and build like, I don't know, Henlo, who's going to do like pump fund, or was it just like, hey, let's go find founders and like listen to all their ideas? Like, how'd you approach it?
Yeah, I think it's almost like two buckets, really. On one hand, and I find that like almost every team has something a little bit missing, right? Sometimes you find a sick founder who are like, yeah, this person's gonna fuck. Like no matter what they do, they're gonna fuck. But they have no good ideas, and you're like, well, shit, we got to find that part. Other times you find a great idea, and you're like, man, this team's kind of lackluster, or something needs to be upskilled here. And I feel like the vast majority of the folks we found were in like one of those two buckets. And then we just basically did our best to help empower them in whatever manner that needed to be, right? So I think that those, if I had to like just categorize schools of thought, and then there's a whole bunch of stuff in the middle and a wide variety of spectrums there, but I think that the ones that I tend to bet on founders more than ideas to start. And I don't think that's like, terribly contrarian in early stage crypto / early stage investing as a whole.
Yep.
So in most cases, it's just like, yeah, this person has like incredible amounts of dog in them. I should probably just, try to throw ideas at them until something sticks. And in many cases, this ends up being like a team / a like hive mind type effort where there'll be like a builders group and people will toss ideas around, or I'll be chatting with, one of our investors or, just a large user on the network or a friend, and they'll say, hey, is someone building this yet? And I'm like, oh, not a bad idea. Just see if we can get someone building that. So I think it's what we're trying to do over time is almost have like more and more of a repository of strong founders and strong ideas sitting around, such that as opportunities pop up, we can help slot those forward. At the end of the day, I think a lot of these will just come about as a result of like of almost entropy in a positive direction, I should hope. But at the same time, sometimes you want to be able to play a little bit more of like a guiding role there.
And Build-A-Bear is another ecosystem for this as well.
You've got it. So like Build-A-Bear is sort of like arm's length accelerator slash incubator that spun off from the foundation, run by the guys Sammy who used to basically take points on Dinero, super sharp guy, and one of the guys I trust the most when it comes to just mechanism design and being an ideas guy, if you will. And the whole thesis of Build-A-Bear is like, hey, like every, let's say 3 to 6 months, let's find a way to really help prop up basically up to 5 different builder teams from within the ecosystem. Sometimes there are folks that will, run with an idea that Sammy might have had. Other times, and I'd say much more commonly, it's like, hey, here's someone who's building something that we think is kind of cool and has a real chance of being unique, 0 to 1, and something that we haven't seen before. Let's do our best to really help these guys as much as we can in terms of access to, capital, in terms of, introductions, in terms of figuring out how to actually, run a company, in terms of figuring out how to get networked in the right spaces in crypto. I think that there's like some degree of YC inspo. But I also think that very different when you're looking at that with 3 to 5 companies versus 120 or 200, whatever the batches are nowadays.
Try like 400.
Fuck me.
We're cooking on something, Smokey.
Yep.
Oh yeah, yeah. Oh yeah, yeah. We got to look upwards.
Look upwards. What else do we got?
I guess what's I know we got to wrap up here in like a couple minutes, but Smokey, what's next, man? Like, what should people be looking out for? Obviously, TG was about 2 weeks ago. What's what's on the roadmap?
Yeah, man. A couple different things. One is like Berapalooza is around the corner, so we'll try to have some fun stuff to chat about over there. 2 is just like what happens when POL rolls out, right? Like who are going to be as in third party POL, if you will. So who are going to be some of the first applicants?
Or is that under wraps?
No, I've learned to never give dates. That always ends
poorly. Launch date. Let's hear
it. No, but I think that it's not too far out. We're not going to edge people for too long, and we'll probably end up leaking a little bit more at Berachain. Right now, just sort of, I'd say right now just doing extensive testing internally to make sure that everything's working as intended. But I think that we'll start to see different teams and different groups that intend on participating in POL sort of lobbying and getting into a little bit more of a public forum about that. And saying like, hey, we're planning to kick back this many incentives and this much in fees. You guys should totally make this happen. So I'm excited to see that.
One quick thing there. What's like the interface? Is there an interface or like how do you see all these different, POL type of these? Just so, like if people are curious, like go explore or like see what's going to be offered.
100%. So they won't be able to see it quite yet, right? But right now, what they'll be able to do is if they go to hub.berachain.com, they'll be able to go to the vaults page. And as they see those different vaults, those are basically different pools or applications that are able to receive BGT. They're effectively, POL eligible. So right now you'll just see those pools within the BEX, but over time, as more and more stuff gets passed by governance, that's where you'll see stuff like actually existing. And I think that's where it'll get very interesting because then you can also see, okay, like these are the different assets being incentivized with. And then you can actually go to different validators and say, okay, this validator's APY effectively is X or Y. If I'm a booster or a delegate towards it. So I think that will be very cool to see just because I don't know, this hasn't been done before. And I think it'll be a lot of fun. And I'm a, big advocate for funky shit happening on chain. And then I think we're just going to see some applications start launching their tokens in the not too distant future. I think that a couple of them have already come out the gates and are doing quite decently. But I think that some of these, big hallmark apps that people are excited about, your Dolomite, Kodiak, Ooga Booga, which has been absolutely cleaning up on the aggregator side, those types should be doing quite well. And then I think we'll probably see like the launch of some of the hyped projects within the ecosystem that everyone was talking about pre-launch. So the Steady Teddies took like the Berachain NFT ecosystem and a few others very much by storm, and have become a cult classic. I think Jenny's meme coin / Henlo and their associated product suite should come out at some point. So I think it'll just be the realization or the maturity of a bunch of random shit that's been in the incubator for the better part of 6 to 12 months.
Nice. Amazing. All right, man. Well, congratulations, dude. Very good work. It's exciting to see what the Bears do over the course of the next couple of years. And obviously, I know we got a disclaimer, obviously, framework. I know you guys have a little proud, but maybe small bag holders or
couple tokens.
But yeah. So anyway, guys, definitely rooting for you. And yeah, guys, we'll have to do like a 6-month check-in or a 12-month check-in or something like that. Or let's do it again sometime soon.
Thanks,
man.
Appreciate you.
Thanks for having me, gents.
Appreciate you, Smokey.